Here. All right, so we're going to talk about where interest rates come from, among some other things. So that's just the title. We're going to hop right in to hopefully start seeing the value right away. So, what rates themselves? So, we're going to talk, this is all just about mortgage rates. We're not talking about any other rates here. So, rates come from the fact that investors buy mortgages, right? So, you think banks, you think funds, you think Wall Street buy home loans as they're bundled together, mortgage-backed securities. So, they buy them. The price, the return those investors demand is the raw cost of that mortgage money. So they demand a certain price in order to invest in a mortgage as opposed to competing investments out there, right? So if you're an investor and you're seeking safe investments, you might be thinking US Treasury, you might be bonds. You're trying to find something safe, and mortgages kind of fit in a similar category where they're a little less risky than some other alternatives. And so you start with that. You start with the fact that investors buy these things, and then their price, what they request or need in order to invest in it, make it make sense to them and their goals. And then you have the lenders building on top of that, right? So the lenders add their margin, their risk pricing. You have things like we've talked about in prior classes, like loan level pricing adjustments. All of these things add up to be what the consumer sees at the end of the day. So move on here. And this is kind of the anatomy of it all. So you start with the raw market rate, which is lower than the rate that the consumer sees, right? Because it hasn't gone up by the lender margin. So you add in lender margin. So this is how much the lender, the mortgage company, needs in order to run their operations. And this is different for every single lender. And that's what I want to emphasize. Um, this is the lender margin is how the companies make money to pay for all of the costs that they have of just doing business. And then, whatever else they deem important. So their margins will just adjust accordingly based on that. And then you have risk adjustments that take place. So loan level pricing adjustments that, depending on how that individual stacks up with their riskiness, right? So you have things like their credit score, what makes up their credit, how risky is that information? How much are they putting down? So how much skin in the game do they have? All of these things change what makes up their rate. Because the riskier someone is, the riskier it is to lend money to somebody, the higher that rate will be because they're going to want compensation for that perceived risk. Um, and so then you finally end up with what the buyer or that consumer sees as the rate being offered with the discount points associated with it, which we'll get into as well. So important note, and most people have heard this as well, but the Fed does not set mortgage rates. So that's a pretty well advertised event that takes place when the Fed funds rate changes and all these things. And a lot of conversations get started, certainly in the mortgage world, as a result of that, because people, consumers mainly, and even some agents will reach out asking, like, what impact did that have on my rate and all these things. Um, they don't directly mean anything to the rates. The mortgages follow the 10-year treasury and mortgage-backed security yields. So with that understanding, mortgage rates track the 10-year treasury closer than anything else. It may seem a little bit weird, right? Because you have a 30-year mortgage being tracked similarly with a 10-year treasury. And the reason for that is most mortgages are paid off on average between 7 to 10 years, either being the home's being sold and the mortgage paid off that way, or refinancing, whatever. So they're looked at and it's viewed within that 7 to 10 year window. And so competing investments, the 10-year treasury, fitting in that same window. So in general, now this is not a hard and fast rule, but in general, the mortgage rate roughly equals the 10-year treasury plus whatever the spread would be. And historically, that spread is maybe 1.5 to 2.5 percentage points to get that. So one thing I wanted for you guys to be able to walk away with a little bit um, is if any of you guys have iPhones, open up your iPhone. And then if you go to the stock tracker, which probably different on everyone's phone, but if you go to the left on mine, I can find where it tracks stocks, and you can actually just search for one and you can put it in there. And So one, and I should have put that right here so you could see, but I'll put it in the little notes here. But essentially, the 10-year one of the 10-year Treasury options that you could track if you just wanted to get a feel for things is a little up caret, right? Like a little up arrow, and then the letters T as in Tom, N as in Nancy, and X as in X-ray. So up arrow TNX. And what this does is it's not going to tell you what the mortgage rate is. So don't be confused. But what it does do is it kind of helps you feel out where mortgage rates are probably going in real time because it can be hard, especially from your guys' vantage point as real estate agents. You don't have the behind the scenes software tracking it all and whatnot. But this is going to give you a general idea. So if you see this 10-year treasury going up, right, green and over time, like week over week, you see it tracking upwards, it means mortgage rates are more than likely tracking upwards over that same time. So they're going up. If you see that 10-year treasury going down, similarly, you'll notice that in general, those mortgage rates are coming down over that same stretch. So it's a really good trend analysis, kind of helps you feel where rates may be going. Um, in real time, right? In real time as best you can without having the software linking it all behind the scenes, but it helps you feel it out and go with that. And I send out a Friday little update out to everyone as mortgage market update where I'm trying to do a similar thing because I think from your guys' perspective more than anything, it's helpful to understand where things have moved week to week rather than a specific rate because that's different from every single lender and it changes with any number of variables, right? We can try and say a rate to somebody, but then that somebody has a 640 credit score instead of the 700 one that you're running with, so that changes it. So, anyways, this helps you feel out just general where things are going. So you can save that to your phone. Um, and one thing that I wanted to point out, like right now, that TNX says 4.641. And when I was looking at kind of some of the rates, conventional mortgage they're tracking right around the mid sixes to high sixes, which is right along that 1.5 to 2.5 percentage point spread that you might see. So again, don't use it. The inappropriate way to use it or inaccurate way to use it would be to look at this treasury and try and just say what the mortgage rate is. Don't do that, but just use it as a trend to kind of get comfortable understanding where rates are moving at any given time. All right. So, what actually moves rates? One of the biggest drivers is inflation. The reason being, because I'm sure you guys have heard this before, but sometimes it's helpful to remember something if you understand why it is probably happening that way. But bond investors or investors in general demand higher yields. So they want a higher return when they expect inflation to erode the value of those future fixed payments. Because what they're doing is they're investing and they're getting future payments that are fixed over time. Well, if inflation is eroding that return over time, they're going to demand higher returns as a result. So inflation going up means me as an investor, I'm going to want more money. Like I need a higher return because inflation is going to eat this. So thereby those rates go up. If you have Fed expectations, right? So you have Fed policy that comes out. It doesn't directly, obviously, impact mortgage rates, but it does signal the expectations of what will happen in the future, and can be priced into, as far as investors are concerned with mortgages as well, as far as where things are expected to go, how things look, how they feel about it, all of it. Jobs in the economy, so economic growth. So the more economic growth that's happening, the more there is for risk of inflation, which means, again, investors want compensation for that risk. So more economic growth would generally equal more inflation, or at least the risk of it, which would raise rates. Okay. Fear and global shock. So in general, there's so many variables, you guys. Like there's so many variables. And I recently did a video talking about it because so many people do ask the question, like, where are rates going to go in the future? The answer to that question is literally nobody knows. Nobody knows. There's just too many variables. So, anyways, with that in mind, in general, um, anytime there's crises or recessions, wars, banking stress, investors tend to flee other investment opportunities. So they're fleeing from those and going to safer alternatives, which would be things like treasuries, like a 10-year treasury, and pushing. So in doing that, they push up the prices and then yields come down, which pull mortgage rates down. Okay. So in general, in times of fear, global uncertainty, wars, rates would come down. So if you're like me, you're immediately thinking, well, what the crap, man? War going on in Iran, like why are rates ticking up over that same time period when we have all this global uncertainty? And so to put it as clearly as possible, um, so that one in particular, the war in Iran, is a little bit more challenging because there's so much oil at stake, right? So think about this just for a second. There's so much oil that goes on, and the pricing of oil has been so impacted by what's going on there. Well, what else does the price of oil have a significant impact over? And that would be inflation. Because the cost of gas to put like to deliver goods and do all that throughout the entire country is impacted by gas, and that cost going up because of oil. Inflation takes over, and that inflationary metric and that inflationary fear is overshadowing what would normally be a decrease in the rate because of the global uncertainty. So you do have these different drivers, you do have these different variables. And then all I want to caveat with that is you can literally ignore everything I just said and just know that nobody has any idea. But if you want to try to grasp some of it, these would be the places to start under like maybe more normal circumstances or less variable driven circumstances. I think a lot of these things probably hold up a lot cleaner. But again, especially with the way the world is right now. I do want to caveat that everyone has access to so much information in real time that things move so fast, things are priced in so fast, things are changing so fast that we just live in a different world than we did 20, 30, 40 years ago. And yeah, so keep that in mind. So why is the advertised rate different from what the buyer's rate is? So again, your consumers do not have a fun job, right? They're being berated. I mean, anytime, like think of it, right? I'm sure any of you have probably experienced it. You just type into Google somewhere like, um, what is the mortgage rate for buying a home today? Well, now it's not just your Google search that starts to return a bunch of stuff. It's also now built into your algorithm for every other thing that you touch throughout your entire existence. And so you open up Facebook and all of a sudden it's like, look at these mortgage rates and blah, 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 blah. And although like it's a ton of information, it's also really hard to narrow down to what the rate the consumer will actually get, right? Because there's always the fine print, and the fine print usually assumes the most perfect of perfect situations. They have the best credit, they're putting down a ton of money, primary residence, whatever. And so all of those risk factors are unique to the individual need to be considered if that individual really wants to figure out what the rate is. Um, and understand that just because their friend got a certain rate doesn't mean that that same rate will cost the same or anything like that, right? So it's good for your friend, but everybody's different. Everyone has different credit profile, different goals, different objectives. So really important to know that. All right, so the rate is a dial, not a number, and I need to speed things up a little bit. So essentially, you have a couple options when you're looking at the rate, and I'm going to show this, but you can pay points. Paying points is just a short way of saying you pay a fee to get a lower than par interest rate. So you can go down in the pricing. You can choose what rate you get. There's par pricing, which means it's either at no cost. So the rate that's closest to no cost. The strict par pricing would be the rate at no cost, but sometimes it's not zero. Either they're getting a little bit of credit or they're paying a little bit, but I'll show you. Um, and then on the other side of that spectrum is they take a credit. So if they take a high enough rate, they may be getting a credit to offset their closing costs. We'll show you this. It'll make more sense. And then the other idea I'm going to illustrate here is every lender fee is essentially a cost for the rate. And this is a very important thing that can be manipulative if not talked about correctly, if not, educated correctly. So I will go over this as well. so you can take a look at it. So I do have tabs open here. I'm going to look over on my screen where I've got the tabs. Hopefully I can, there we go. So Monica, let me know if this does not come through correctly. I think it should be sharing that. Yeah. Okay. Yeah.
Came through great.
Okay.
Yes.
So this is, you can ignore, this is the software behind the scenes. This is a test file. So this is nobody's information, not applicable to anyone or anything. This is like meaningless information all the way across the board, but a good illustration. Okay. So at the very top, you'll see an interest rate. Okay. So what first thing I'm going to do is I'm going to open up the rate table. So you'll see that there is not just an interest rate, at least when someone is working with me or Monica, there is not just an interest rate. There are options, and those options range from currently on a conventional mortgage, 7.875, primary residence purchase, by the way, 7.875 all the way to 4.75. What you do see is the cost, which is the second column here. The cost goes from not expensive to quite expensive, but it's still there, right? It's still there. They exist. Um, and so if I was looking for someone's like, hey, what's the par rate today, right? I'm saying one of these two. Neither one is exactly par, right? This one's giving a little bit of a credit, and this one is charging some money, but it's right in that range. That's kind of where par would be. So let's just, I'm going to just choose this one so I can illustrate with the points aspect here. I'm going to choose one with more points, actually. We can see, let's just go this. Okay. So this is saying 1.046 in points. You guys hear about discount points a lot. What that is, to get that to be a dollar figure, you take that, which is saying 1.046%, and you times it by the loan amount to get the dollar amount. Okay. So if I go here, look at the loan details, I'm going to figure out what the loan amount is. The loan amount is $475,000. So I would take out my calculator, even though it's showing me here, but I'm going to back into the cost for you. So 0.0146 times, what did I say? 0.01046. 046 times 475. You end up with a dollar charge of $4,968.50. So what that's essentially saying is that is the fee to get that interest rate. That's what someone would have to pay at closing to lock in or to get that 6.75% interest rate. Now here's where it gets a little weird. Okay. So I'm going to take you'll notice there's a whole bucket right here, origination charges in section A. So I'm going to take you to what like an example loan estimate that every borrower gets at one stage or another throughout the transaction. When they go into contract, they're going to get what's called a loan estimate. It's regulated, so the format's always the same. So what you see right here on your screen is what they see. This is on consumerfinance.gov. So decent tool for borrowers to be able to learn a little bit more about the form. But what I loved is if you come in here and you look at loan costs, because that's all I want to focus on is section A of loan costs for our purposes here. It's origination charges. If you click on that, I'm going to, a lot of good information right here. And then at the very end, it says common origination charges include application fees, origination fees, underwriting fees, processing fees, verification fees, and rate lock fees. And then it ends it with the most important part. And it says it's the total that matters. So the reason that it's the total that matters, and the reason it's so important for consumers to realize it's the total that matters, is let's play out a scenario here. So I have a processing fee of $9.95, a doc prep fee currently of $365 that are in here as well. Okay, so the total origination charges are $6,328. And then you have the rate of 6.75. Well, one way of maybe changing how it looks, right, is I could charge a 1% origination fee, so a $4,750 origination fee right here. And what I could do is I could reduce this by 1%. And so I could have points be basically, it would just be whatever 0.046 times 475,000 is, but really low on the points, but it would have an origination charge. So one could theoretically say, hey, this is the new par rate, right? The closest one at that discount point to zero. But the cost, that total of this section is what matters. call it whatever you want. You call it a processing fee, you call it an origination fee, you call it an underwriting fee. All of these are fees to get that associated rate. One way or another, if you want to do business, that's the fees. Those are the fees that are being paid. So I think it's a bit disingenuous to kind of frame it any other way, because it's important for the consumer to understand that, in order to compare apples to apples, certainly you need to look at all of the fees in that bucket. And that's how I appreciated what they said here, where it's the total that matters. So whatever the line items are, it's whatever, call it whatever you want to call it, say whatever you want to say, but at the end, that total is a really important number. All right, moving on. So a couple options that can have a profound impact. This is a whole other class that we taught, but I wanted to kind of throw it in here just for you guys as a reference. The least impactful generally, if you're looking at a buyer's payment, okay, and that like their payment, they're super sensitive to their payment, and they're trying to have the biggest impact on their payment in general to lower that amount. First thing, probably least impactful. Let's say you have $10,000 available. You can do a price. They could do a price cut on the home of 10,000, right? They could offer $10,000 less on a home. The payment won't move as much in general as a $10,000 permanent buy down. So this would mean, like I just showed with the discount points, maybe they're putting $10,000 of discount points out there to buy that rate down permanently for the full 30-year time frame. Or there's a 2-1 temporary buy down, which is more drastic, where it's going to reduce that payment quite a bit. So in that same scenario, if we were to throw in a 2-1 buy down for that same thing that you just looked at, it'd be about a $10,900 cost to the seller. And you in year one, for the first year, it would save the borrower $600 per month. And then for the second year, it's going to save that borrower around $300 per month on their payment. And then after that second year concludes, it's back to that original payment. So it buys them some time. If they really felt that they could refinance in the future, whatever the case may be, maybe they like that 2-1 buy down. But for listing agents, for anyone listing homes, this could be a great tool, right? Rather than taking a price cut, attacking or maybe leveraging the fact that there's 2-1 buy downs available, things like this exist. If you want to price it out, reach out to me or Monica. We can price one out. We can try and figure out what that's going to look like, so you understand what the impact would be to your seller if they were, if you guys were talking about it and trying to promote that type of a thing rather than the price cut. Yeah. So tools to help manage where rates are and where they're going and how everyone feels about them. So some things to say to your clients, to help them understand things. Obviously, the Fed doesn't set mortgage rates. So some quick things the bond market does. There's no such thing as a no-cost loan. I mean, there's always like someone's going to be paying something. Let's just put it that way. No one's in it to lose money. Never compare rates alone. You compare the rate and the total lender cost. Again, super, 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 super important. Don't be misguided. It's all very important. The fees are what they are. At the end of the day, it's just math. So help them walk through it. Some upcoming classes that we have, you can scan the QR code here to sign up for any. Again, our goal is to keep them 30 minutes or less. We're trying to get useful information. We're hopefully with this class, you can see we're trying to spin it in a different way too. In a lot of these cases where we're sharing information that is not so boilerplate, but is hopefully a little bit behind the scenes that help you guys help your clients more and maybe push them in the right direction, or just get them in touch with us because you know that we know. Yeah. So sign up for some more classes as they're coming up here. Again, we're just doing them to hopefully benefit you guys and not take up your entire day. So Abby, you can change it. We'll take questions if there's any questions right now from
So
anybody.
we do have a question, Jared, and I
Stop
think
sharing
you
the
and I
screen.
are kind of in the same um, kind of thought process. And this is a really important question that we get a lot is when is a good time to lock in the interest rate? And I know like I saw you did a reel about this, I think last week on social, and I had just repeated the same thing to a borrower earlier that day. So if you could maybe touch on that to answer that question on when does a buyer know when to lock in the rate?
Well, I think I actually heard this from you originally, Monica. Like this, I was like, that actually makes a ton of sense. So if you really truly believe, like I do, that no one knows where rates are going to go. You wake up tomorrow, like doesn't matter, right? If someone really felt that inflation was going to be whatever and that rates tomorrow, based on the report that's going to come out, they just know the rates were going to come down. Well, overnight, a new war could start, and the whole thing is kaput. Like boom, gone. Doesn't matter what you thought. Rates are changing. So with that in mind, where nobody has any idea where rates are going to move, really, from moment to moment, they could do anything. Then really, what you're going to fight when you're answering the question of should I lock in my rate is you're fighting your own personality, and how you're going to see it. So meaning like probably Vegas is a good way of illustrating this, right? Like if you go to Vegas and you go and you're at the roulette table or whatever, are you the type of person that just puts all their money on black? You know, you're the risk taker. You're like, hey, let's do this, and you get a thrill out of it, and then you walk away, and it's like, oh man, yeah. Regardless of the result, obviously you feel bad if you lose it all, but then maybe you're the type of person who can withstand waiting to lock, and then that rate maybe getting more expensive because you waited, it didn't get more favorable, but hey, you took the risk. That's just your personality. Like you'll live with it, and you'll lock it in maybe at a future date because it's like, yeah, I see the writing on the wall. It's time to lock it in, time to move on. So maybe that personality has the tolerance to wait. The other side of that coin would be someone who, and this is more like me, if I'm being honest, who just like, you know, if they decided to like, okay, let's just wait, and then rates got worse, then they would beat themselves up, and they would consider like just sit there and think over and over again like how they missed this great opportunity, whatever. Then you're probably better off just locking it and forgetting it altogether. You just lock it and move on, and don't look back at where rates are moving or anything like that. You just lock in what you know, and move on. And that's probably the camp that I fall into more than anything. I'm not big into risk, so
No,
yeah.
I think that is a really helpful answer. You know, with working with clients for so long, it's like let's test your risk threshold. Are you going to be more angry if you lock in and rates go down, or are you going to be more angry if you didn't lock and rates went up? And so, kind of taking a step back because it is hard to predict what rates are going to do because there are things just outside of our control that are impacted by the world. Sometimes that can be a really great way to approach it with a client. So if you have a client you're not quite sure, maybe kind of help them think about that in themselves. Like, what is their risk threshold? So
Yeah,
that's super
for
helpful.
sure.
All of that was such good information to kind of understand how those rates are calculated. So, if you are someone who wasn't able to make the class and you're listening to this recording later and have questions, please don't hesitate to reach out to Jared or to myself. And I wanted to point out one thing he mentioned. He does like every Friday send out this amazing overview that can give you some really great social content or just have some things to go over with buyers, you know, just to stay in what's happening with the economy without having to dig into it yourself. So if you want to do that, make sure you reach out to Jared and request to be put on that marketing campaign that he sends out every Friday. Good content. And we're at time. We're at time,
Sweet.
Jared. So that's all we have time for today. And we are excited to see you on the next class.
Okay, thanks everybody.